We all have this instinct. If you put your money behind a heavy steel door, lock it, and walk away, you assume it's completely secure. And physically, it is. Nobody can touch it. But if you come back 5 or 10 years later and open that vault, will that exact same stack of bills actually do the same things for you? The numbers printed on the paper haven't changed, but wealth relies on what those bills can actually buy in the real world. In finance, this capability is called your purchasing power. Keeping cash locked away in a physical or digital vault protects it from theft, but it does absolutely nothing to protect the actual wealth those bills represent. Let's look at how this mechanism works using a standard 100 rupee note today. Right now, that single note guarantees you a specific amount of goods. It buys a couple of liters of milk or a basic meal. This timeline stretches into the future. The 100 rupee note keeps its numerical value, but a descending trend line tracks its purchasing power dropping. It buys less milk and a smaller meal. We call this inflation, a persistent decrease in what your money extracts from the economy. Even if your savings account balance never drops by a single digit, the intrinsic strength of that money is constantly shrinking. The reason this happens has nothing to do with the physical 100 rupee note itself. It happens because the economy surrounding that note is constantly moving. Think about the absolute non-negotiables for human survival and progress: the groceries we eat, the fuel we use to commute, our housing, and our education. This chart tracks essential costs moving upward. The cost of groceries, fuel, housing, and education creeps higher over time. When everyday prices move up, it triggers a downward plunge in your money's capability. The higher prices climb, the lower your purchasing power falls. Because the cost of existing constantly accelerates, holding on to an unchanged savings balance means you are mathematically moving backward. You can view this economic reality as a continuous, invisible tax levied on stagnant savings. In finance, everything is dictated by relative velocity. If the baseline cost of living in the economy grows by 6% a year, and your money is sitting in an account growing at 0%, you aren't breaking even. You are losing 6% of your real wealth annually. Over a few months, a gap of a few percentage points is barely noticeable. But when you stretch that mathematical loss over 10, 20, or 30 years, the compounding effect destroys the majority of that capital's value. Choosing to keep your money at a 0% growth rate guarantees long-term financial decay. Passive saving has to evolve into active wealth generation. This diagram shows two distinct paths. The downward line is stagnant money losing its power. The rising line is invested money. The primary objective of investing is to push that rising line until it crosses above the horizontal inflation baseline. The goal is to mathematically outpace the rate of decay. Pushing that line upward requires a growth plan built on 3 strict variables. You have to define your specific financial goals, map out your exact time horizon, and determine precisely how much risk you can tolerate. When you project those 2 lines across a multi-decade span, the gap is massive. The stagnant line collapses towards zero utility, while the active investment line compounds upward. Preserving your wealth requires ignoring the face value printed on your bills and focusing entirely on protecting their actual purchasing power. Let's apply this growth mindset to a real, tangible milestone. Say your goal is to accumulate exactly 1 crore rupees. To mathematically outpace inflation and hit that precise 1 crore rupee target, how much capital do you actually need to start with? And how many years will it take? There is a specific, calculable formula to bridge that gap, and that formula is exactly what we are going to build in the next episode.
Like, share, subscribe कर दो यार.